commercial real estate values are more challenged today. If we look at the underlying dynamics, so we talked about job growth. Obviously, some markets are positively impacted by population growth. The Sun Belt, some of the Rocky Mountain states, some of the Southwest, South Central have been impacted by the migration of population to those areas, which more migration, more in migration means that there is some basic need for commercial real estate.
Your daily real estate syndication show. I'm your host, Whitney Sewell. Our guest today is Brian Bailey. We're going to do a series with him. He's a subject matter expert and senior policy advisor in the Supervision and Regulation Division of the Federal Reserve Bank of Atlanta. He provides thought leadership, monitoring emerging trends in commercial real estate finance, industry dynamics, valuation, operations. He's a keynote speaker all over the place about the economy, the reserve banking, a number of topics that we need to know about. So he is a great guest. He's got the degrees, he's CCIM designations. He's got the knowledge, the input, the experience of watching these trends, and even been in the business before being part of the Fed as well, where it's just great show, right? He just dives into, man, are commercial real estate values accurate? He's going to talk about a number of things around that. We're going to talk about the health of the banks. We have a kind of a back and forth conversation a little bit about the health of the banks and what you need to know. And you're going to hear another segment about another set of topics that I enjoy quite a bit. I know you are as well. Brian, welcome to the show. I'm honored to meet you and have you on. I was listening to some things about you, some keynotes that you've done in the past, and it's honored to have somebody on the show with your level of experience and knowledge. I know the listeners are going to learn a lot from you over a series of shows that we're going to do here. And so I know in the very beginning, you need to share a disclaimer. I want you to knock that out so we can dive right in, and then let's share a little bit about, or you share a little bit about your background, and let's do it.
Great, absolutely. And Whitney, first, thank you for the invitation to be on your show. Appreciate the opportunity to share a few thoughts today with the listeners. No good show would be without a disclaimer. I certainly need to plug our attorneys, but from a transparency perspective, I want to be forthright in that these are my opinions today and not necessarily those of my colleagues at the Federal Reserve Bank of Atlanta, nor the Board of Governors. And just to be clear, we're recording this the first week of September, as we have an FOMC meeting that's a little bit over 2 weeks out.
Awesome. Well, Brian, give the listeners a little more about your background, and let's dive in.
Absolutely. So I've been at the Fed a dozen years. There are a bunch of folks across the system that refer to me as the Fed's subject matter expert in commercial real estate. I'm at the Federal Reserve Bank of Atlanta. I am a subject matter expert for the Atlanta Fed in commercial real estate. And my job is to be able to provide real estate expertise and data for our examiners as they're in the banks doing bank exams, making sure that the banks are in compliance, making sure that we are on top of the safety and soundness of the financial system. Additionally, I provide information to a wide range of policymakers, et cetera, as they have questions on commercial real estate dynamics. So on that front, well versed in commercial real estate. Prior to coming to the Fed, I spent about 15 years on the private side of commercial real estate. I spent time as an appraiser, ran my own development company for a few years, was also an executive with the Big Four accounting firm Ernst& Young, doing real estate work for their clients for a number of years, ran real estate finance for Florida's largest commercial developer, Flagler Development, as we built a couple of million square feet up and down the east coast of Florida every year. And then I ran acquisitions and finance for a private equity firm with global real estate holdings to the tune of of a few $1 billion before coming to the Fed. So spent a lot of time in commercial real estate.
Yeah, that's awesome. I love the expertise and just the wide range of experience, and you're a perfect guest. Brian, I thought maybe I was just thinking about this, but right at the beginning here, maybe you could just give us kind of an overview of some thoughts on the current state of the economy, even and maybe back up a little bit the last 6 months, some things you could highlight that's affecting the economy right now, and specifically commercial real estate. And then let's kind of move forward to what you expect in the next 6 months as well. And we'll dive into some, I want the listener to know we're going to dive into a number of specific things in, but yeah, I want you to give us just kind of an overview of some thoughts and we'll dive in after that.
Sure. Well, my thoughts on the economy, we could probably have a month's worth of shows, but let me boil it down pretty quick. I think that there are both head and tailwinds right now. I think that we are seeing hot, we've seen a very sizable increase in the Fed's funds rate, courtesy of the Federal Reserve, as we've worked very hard to fulfill our mandate of price stability. And from that standpoint, as you have increasing rates, traditionally you have a slowing economy. Our economy has been the US economy has been very resilient. We've had job growth well in excess of what we need for the natural population rate. So we're creating on average in 2023 roughly 200,000 jobs a month, which is well in excess of what we need to keep up with population growth wise. At the same point, we've seen that number begin to decelerate a little bit. And it certainly has decelerated from the results in 2022, where we had an average over 400,000 jobs a month created. And in 2021, bouncing back from the pandemic effects, we had roughly 600,000 jobs, give or take, created every month in 2021. So we're seeing that slowing. At the same point, we've benefited from energy prices coming down up until the last 60 days or so. We've benefited significantly. So I think there are both head and tailwinds right now that are impacting the economy. One I know that we will talk about later is obviously the implications in lending right now, as the higher rate environment, coming out of a higher rate environment from a low rate environment, has created greater uncertainty, has created challenges with accurately assessing, pardon me, what commercial real estate property values are. There have also been issues with higher costs. So on that front, I think that there are a number of both positive and headwinds that have been impacting the economy, but we've been fortunate that the economy continues to be resilient, healthy.
Yeah, no, I appreciate that very much. Yeah, I would love to talk about the are commercial real estate values accurate? How you see that right now, just at where we're at in the cycle. Do you feel they're accurate? Maybe speak into that a little bit.
I think commercial real estate values are more challenged today. If we look at the underlying dynamics, so we talked about job growth. Obviously, some markets are positively impacted by population growth. The Sun Belt, some of the Rocky Mountain states, some of the Southwest, South Central have been impacted by the migration of population to those areas, which more migration, more in migration means that there is some basic need for commercial real estate. The consumer continues to spend. We have seen an increase in their propensity to take on debt, which we need to watch. We know that the addition of debt may signal that their budgets are more challenged. And from that standpoint, they continue to spend, but at the same point, there may be a little bit more risk in the near future. We know that there are changes coming, i.e., the restart of student loan payment. And on that front, I think the median payment is $225 to $250 a month. Obviously, not the end of the world, but it's certainly, if your budget is already been heavily impacted by rising costs associated with inflation or whatever, from that standpoint, another $200 a month could very well create challenges. And if that's the case, the consumer may pull back, which may impact retail. So I think there are some areas that impacting commercial real estate. If we kind of take it down a level to the specific types of real estate, which I know you wanted to talk about, retail continues to do very well on that dynamic. Our friends in the press talked about the retail apocalypse for many years. And on that front, I think that sentiment, that negative sentiment, drove a lot of developers and a lot of lenders to think very conservatively regarding the construction of new retail. From that standpoint, because of the times the press talked about the retail apocalypse and e-commerce was taking over the world, I'm exaggerating just a hair, but in essence, that dynamic, that sentiment really pushed a lot of that newer retail to the sidelines. And so nationally, we built somewhere between 25% and a third of the amount of retail that we had built over the preceding 20 years. So from that standpoint, we have a lower amount of retail that's been built in the last 10 years. And on that front, I think we don't have this huge oversupply in the retail space. Where we do have some oversupply, multifamily. Interesting, I can say that in a time where we have a housing shortage. So I'm sure we'll have some listeners kind of scratching their heads. There is a housing shortage. At the same point, we do have oversupply in the multifamily space because most of the projects that have been built in the last few years have been aimed at the luxury high-end segment versus where the shortage is, and the shortage is in workforce and affordable housing, to be clear. So we are seeing vacancy rates going up in a lot of those higher end multifamily projects.
I think that's a valuable point to be made there. So many people, oh, actually, even earlier talking about even in the retail piece, how all the headlines and the over and over kind of scare everybody as a whole, right? It's kind of how perception becomes a reality to some degree, right? But I think when you're talking about multifamily now, everybody's talking about this oversupply, or we're talking about a housing shortage, right? Housing shortage. But it's interesting. Well, when you dive down, like you said, the oversupply has been in luxury, right? Or that's been where it's been built. While I feel like a lot of people are building luxury while using that statement of the housing shortage to kind of fund the deal, right? And make the story happen when the shortage is in a different class of multifamily, right?
You bet. I mean, we've seen building costs grow significantly. And I think from that standpoint, what I've been told is that only the luxury premium projects right now are the ones that are financially feasible. It's interesting when you think about the perception. A couple of things come to mind. One, had a good friend in 2021 who's heavily engaged in the multifamily space. They have a portfolio. He's a CEO of a large REIT, a large ownership company of multifamily. And he in essence said, over my 30 something years of experience, 2021 is the best year in the last 30 for effective rent growth. What we've seen though is we've seen that slowing occur, and now we're seeing concessions which were virtually non-existent in 2021 grow to somewhere, depending on the market, 2 to 6 weeks of free rent right now. So it's fascinating on that front as far as the perception. still have a significant amount of those luxury units under construction right now. So I do think that for some period of time, we will have essentially an affordability. You've got an affordability issue on the luxury end while you have this shortage of housing on the lower end.
Yeah. Yeah. No, yeah, you nailed on down there a little bit or brought that out. What about, well, for time's sake here, I want us to jump into just the health of the banks a little bit. And I know we'll talk about interest rates and some of those things, but just what's happening with banks right now, or maybe some recent regulatory changes that investors or operators need to know about. And let's dive in there a little bit.
Sure. I think right now, let's kind of, so first and foremost, the banking system is healthy and well capitalized. As far as the large banks are concerned, annually they have to go through the comprehensive capital assessment review, CCAR, which are the Fed stress tests. The Fed gives them assumptions and they have to show how it impacts their capital. From that standpoint, they are well capitalized. I think what we have seen is we've seen more uncertainty enter the banking, the lending, the commercial real estate lending environment right now. And part of that driven by the increase in rates, part of it driven by we think about what's going on in commercial real estate. We talked a little bit about this overbuilding and affordability issue in multifamily. I think we've got some overbuilding that's going on. We're in the early stages in the industrial sector. On the other end of the spectrum, we have a change in use, the change in the way we're using office space right now. Yes, it's impacted by work from home, but we're also, now that employers are focused on it, they're looking at not only the crowd that works from home, but also the crowd that travels. From that standpoint, if you travel a significant amount, you may be better suited. It may be more efficient for the employer to generate some kind of telling process. And that way, a couple of folks or group of folks can share space that are not in the office every day, or maybe they're in the office once or twice a week. From that standpoint, we are changing the way that we use space. We've had remote work back to the 1960s. And on that front, every 5 or 10 years, the amount of remote work has doubled. The challenge is we got to the pandemic, and the pandemic growth in remote work grew fivefold over that very short period of time. So we accelerated work from home. We've got some studies now. We've got coming out of the academic environment where, in essence, people who work from home full time are not as productive as those who work kind of a hybrid schedule. So on that front, I want to say I'm in the camp that we will be back in the office. There will be a hybrid model. I don't know, 2 days a week, 3 days a week, 4 days a week. It kind of depends on the nature of the business, depends on the industry. But on that front, I think that there is going to be a hybrid model that will be mostly be more adapted than, say, 5 days a week back in the office.
Yeah, I can see that for sure. I've been a remote worker for a long time. I was also a federal employee for a number of years, and it was even remote then. And so I can see that people are more productive when they're at the office more, at least, as opposed to never, right? And the FaceTime with other employees and the interaction that happens. And our business right now, we're all remote. There's no office where any of us really are together, but we try to do that virtually, right? Where we are having kind of interactions. So we even have something we call a water cooler meeting. There's no agenda. It's just like, hey, how you doing? Just so there are some of those interactions. But man, it is something that I don't think it can be replaced, right? Having some in person time.
I think as a society, we've undervalued
Yeah.
that transmission and transfer of knowledge to the younger generation. So I think it has been undervalued. You asked me to talk about the health of banks. Let me take us back. So I think the large banks are, because of the CCAR stress test, from that standpoint, they are well capitalized. I think looking at the smaller and regional banks, which account for 40 to 50% of commercial real estate originations, certainly we saw some liquidity events pop up earlier this year, which I think is part of the dynamic coming out of the added uncertainty in the change associated with the change in rates. And I think, commercial real estate is a byproduct of that. Being a capital intensive industry, from that standpoint, as the cost of capital changes, it hits those capital intensive industries squarely. And I think that's what we're seeing in both commercial and the residential environment right now. So on that front, I think banks are a little bit more hesitant right now as far as lending is concerned. At the same point, they remain healthy.
Yeah. Well, it is a challenge, no doubt about it. Right. Finding debt that helps, makes the deal work right now. Right. I mean, everybody I'm interviewing is saying the same thing, right? Well, we can't make deals work right now. There's no deal flow that, or really debt that can makes a deal happen, right? It's too expensive, or obviously with interest rates. What are your thoughts about where interest rates are now, or maybe expectations of interest rates, the path for that moving forward, and how that affects the commercial real estate industry?
Let's shelve that question for a minute and back up to I love your comments where your folks are saying, hey, it's hard to get capital right now. Yeah. And one of the areas I think, thinking about that, why is that? Well, one is the value. We're uncertain. The industry is uncertain about where values are today. I think that part of that has manifested itself in that there's been a flight to quality. If you look at what's trading, to use an example, think about fast food. There are lots and lots of folks, I'm one of them, that love Chick-fil-A. From that standpoint, I think the Chick-fil-A's continue to trade. They continue to trade low cap rates. But, and I'm not going to name the fast food establishment because I'll get in trouble, but think about one that's a little bit lower on the quality, lower scale. From that standpoint, those are probably not trading. And from that standpoint, I think that uncertainty around what the actual cap rate is, value, has created some pause with the lenders. Additionally, we've seen lenders, because of the uncertainty with liquidity, with the uncertainty in commercial real estate, all of a sudden they've said, hey, we're gonna tighten our underwriting standards. So from that standpoint, loans that were made in the past that were perfectly conservative, all of a sudden may not meet the current underwriting standards. And from that standpoint, value may not be there. You may, in essence, need the cash. You will kind of chuckle about the cash out refi, which is popular in commercial real estate, but this may very well turn into the cash in refi, as because of increased debt service costs, because of declines in value, loans may not meet the conservative underwriting standards that banks are setting. And from that standpoint, they require equity to be put in the deal. I think third, from a challenge, is that lending has changed. So your normal lenders, the banks, et cetera, capital continues to remain available. But some of the areas where we've seen tremendous growth, i.e., some of the non banks, are not actively engaged in commercial real estate lending to the rate that they were historically. So if you have a loan with one of those non-banks and they're not active, that puts greater pressure on you to go to a bank or another lender that continues to remain active, which may have different different underwriting standards at that point. So I think that there has been some changes in the lending environment, in today's lending environment from where we were 12 or 18 months ago, whether it's value, whether it's higher underwriting standards. I think there have been changes, and that may make it harder. I think it is making it harder for borrowers to get capital.
Yeah, no doubt about it. No doubt about it. I love the even the thinking through the Chick-fil-A comment versus a different brand that may not be known as well, or maybe, but assumed as lesser quality potentially, and how that influences things. But this, you said this may turn into the cash in or refi time. I'm seeing that happen, right? I've talked to a number of operators that I know and even had on the show that that's what's happening, right? And they're hoping at this point that they have the capital, right, to make that happen and are not having to do capital calls or turn the property over, right, to the lender. And I know that's starting to happen a little bit. And I think a big expectation, it seems, is that's going to be happening a lot more over the next 6, 12 months. Would that be your expectation as well?
I think so. One of the things that's kind of on our radar screen is there's a significant wave of commercial real estate debt that's maturing over the next 5 years. Not insurmountable. We have certainly scaled these levels of maturities before, but certainly in an environment where there's more uncertainty, whether it's accuracy of value, whether it's underwriting standards increasing, whether it's the number of lenders that was lending 12 months ago has pulled back. So there's been a curtailment of lending. From that standpoint, I think there are a number of headwinds to get us over that may create challenges refinancing this $2.5 trillion in commercial real estate debt that needs to be refinanced over the next 5 years. I think that potentially, again, it depends on kind of the area, the lender. When you think about next year, 2024, there was about $100+ billion that was originated from investor-driven funds, hedge funds, private equity, et cetera. You think about kind of the typical MO of hedge funds, private equity, they traditionally take more risk. They probably offer a higher loan to value. They offer more proceeds, but you have to pay for that. From that standpoint, if they are not lending, then in a sense, you may have to go to a bank, which does a more conservative profile loan. Certainly the regulators are watching and they don't want to spend more time with me. And from that standpoint, I think that then you may have to have the cash in refi. So I do think that lending is changing right now, partially driven by the segments of lenders where your loan was originated.
Brian, we're going to have to end this segment here. And I want the listeners to know we're going to have another segment with Brian. We're going to continue the conversation. Brian, where can they learn more about you? Should they go to atlantafed.org, or is there another way they could reach out to you in any way?
Oh, that's perfect. The Atlanta Fed certainly works very hard to make my information available. We want to do as good a job as we can at being transparent and pushing information to the public. So please, atlantafed.org is great.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.